Happy Friday, everyone. Welcome to our weekly Outlook webinar for the new trading week. We're here to prepare for the first trading week of the month of March, actually. My name is Ilian Yotov. I'm familiar to many currency traders as the creator of the Quarters Theory. I also host a popular daily program called the All Things Forex broadcast. You're welcome to check it out Monday through Friday on my website, allthingsforex.com. And as always, you can take a look at my book, available everywhere books are sold. The name of the book is The Quarters Theory. The Quarters Theory, the revolutionary new foreign currencies trading method. Now, we're here today to prepare for another busy trading week, which is going to put the spotlight and keep the spotlight on the euro and the U.S. dollar. We're going to have a sequence of important U.S. economic data that's going to continue to give us an opportunity to gauge the condition of the U.S. economy, while at the same time, we're going to next week start gauging the next move as far as monetary policy is concerned by the European Central Bank. As you know, the European Central Bank's announcement is coming up on Thursday, March the 4th, which is the week after next week. But before that, the main spotlight economic event for next week, which I have chosen to bring your attention to, will be the European Central Bank's long-term refinancing operation, or second round of that, which we'll talk about in a few minutes. So needless to say, the euro and the U.S. dollar are going to be in the spotlight next week. Now, next week, also on Wednesday, if I'm not mistaken, we're going to see the German Parliament voting on to approve the bailout funding and additional funding for Greece from Germany. And there are some reports of growing opposition to that in the parties there in Germany. There's also a report today in Financial Times that European creditor countries to Greece have demanded 38 specific changes to Greek taxes, spending, and wage policies that have to be implemented by the end of the month. I mean, obviously, we don't have a whole lot of time left until the month of February ends. It ends next Wednesday. So, without a doubt, the euro is going to remain in the spotlight, as I said earlier in our program on Friday, if you recall, and also throughout this week on my All Things Forex broadcast. Greece is not going to immediately default, but there is, at least for the time being, with the approval of the bailout package, the mismanaged default has been averted. However, there's still plenty of work to be done. And we're going to keep an eye on all of these events and developments throughout next week. The very first spotlight economic event for next week I've chosen to be from the United States with the pending home sales index. That's going to kick the sequence of important U.S. economic data that's going to be released throughout next week. Earlier this week, we already saw the existing home sales, not as strong as expected. And the new home sales were also released, I believe, about 10 minutes from now. They were expected to be a little bit higher, but let me take a quick look and see whether or not that was the case. We'll have to bring that up really quickly here, if you bear with me. And the U.S. housing market data is going to continue the sequence on Monday with that pending home sales index, which is a leading indicator of future housing market activity. It measures contracts that are pending for home sales. There are signed contracts for homes that are to be sold in the near future. It's a preliminary gauge, if you will, a leading indicator of conditions in the U.S. housing market. Now, the new home sales about 10 minutes ago showed us an increase to 321,000, which is a little bit more than the consensus forecast for a move to 315,000 from 307,000 in the previous month. So the reason why we need to pay attention to all of the U.S. economic data, as I've been talking about this since pretty much the beginning of the fourth quarter of 2011, is because it is important to gauge whether or not the U.S. economy is doing well, and then ultimately that's going to let us gauge the next move by the Federal Reserve, especially considering the Fed's interest rate next monetary policy meeting and interest rate announcement is coming up also in a couple of weeks from now, on March the 13th, is going to follow the European Central Bank's announcement on Thursday, March the 8th. And, of course, next Friday we'll talk about these events again as we prepare for trading week that is going to bring us the European Central Bank and Bank of England and also the Reserve Bank of Australia and the Bank of Canada interest rate announcements. I already gave you some of the 4 of the top 10 events that we're going to talk about on this program next Friday. But it's important to see the U.S. economic data showing resilience, as I've explained in the last, like a broken record pretty much every week on this webinar. Because depending on how the U.S. economy is doing, that's going to give us a hint as to what the Fed's next move is going to be, and especially whether the Fed is going to be deploying at any time soon QE number 3 or another round of quantitative easing, which we have seen very clearly, especially after that unexpectedly dovish statement by the Federal Reserve earlier this month that the Fed is actually waiting to see whether U.S. economic conditions will continue to improve or deteriorate. And if they do deteriorate, then it will be only a matter of time before QE number 3 is announced. So as long as U.S. economic data shows resilience, that reduces the odds for the Fed doing more quantitative easing, which I explained previously is ultimately could be a U.S. dollar cost in the long run. The pending home sales in the U.S. are expected to improve, increasing by 1.1% month over month, compared with 3.5% month over month decline in a previous month, following the a little bit better than expected stronger home sales, new home sales that we witnessed earlier this morning. This could be another cautiously optimistic housing market report from the United States. Obviously, as I've also said previously, I'm not expecting any miracles, not at this point, from the U.S. housing market. It's still rather weak, but it could instill some cautious optimism. Moving forward, on Tuesday, we're going to see the U.S. durable goods orders, which is also an indicator of economic activity, measures orders for durable goods in the United States. It is due on Tuesday at 8:30 a.m. Eastern Time, and unfortunately, that could be one of the weak spots with the U.S. economic data, as the durable goods orders are expected to actually decline by 0.6% month over month, compared with the 3% expansion in the previous month. Again, this could be a bit alarming as a weak spot in the economic data throughout next week, something to pay attention to. The core durable goods orders also are expected to show a smaller increase by only 0.3%, compared with 2.2% in the previous month. That's going to lead us to another spotlight event on Tuesday morning from the United States with the U.S. Consumer Confidence Index, which is a gauge of consumers' outlook on the economy. That index has shown a trend of improvement, and that trend is expected to continue with the Consumer Confidence Index increasing to 63.4, compared with the previous reading of 61.1. And that could at least make up for the decline in durable goods orders, let's hope. Overall, out of the first 3 top 10 events from the U.S. next week, 2 of them are expected to be positive, 1 of them not so positive. If that continues to be the case, and most of the economic data throughout next week continues to stay on the positive side, we can see the odds of QE number 3 staying reduced, at least throughout next week. Now, after the 3 spotlight events from the U.S., we're going to see the European Central Bank's long-term refinancing operation. Now, this is new to some of you. Let me quickly explain what that basically means. The long-term refinancing operations by the European Central Bank are, in essence, 3-year interest loans, 3-year loans with very low interest rate, only 1%, which is the benchmark rate in the Eurozone. And it's offered in unlimited quantities to European banks. In other words, the banks are free, are welcome to request as many funds as they would like from the European Central Bank, and the European Central Bank is willing to loan them those funds at a record low interest rate of only 1% for 3 years. In a first long-term refinancing operation in their first round, which was on December 21st, we saw that event serving as a euro negative. In a way that we saw on December 21st, a lot more than expected amount that was requested by European banks. In the amount of record, 489 billion euros was the takeout at the first round of financing on December 21st. Now, the estimates for next Wednesday, which will bring us the second round of LTRO, are very wide. The range is very wide, anywhere from 300 billion euros to all the way up to 1 trillion euros, which, of course, I'm not sure whether we'll see that record amount of 1 trillion, but if we do get to see a record amount again being requested by European banks, then in December that was a signal that they are not doing that well, that they really need that financing from the European Central Bank and reaching that record amount. What are the two risks? Well, the two risks are the same risks that we discussed in December. The first one is that financial markets and banks in the Eurozone could become even more dependent on European Central Bank funding. The other risk pertains to the actual balance sheet of the European Central Bank, which is already at record high levels, and with that additional second round of long-term refinancing, is about to increase even more, according to the consensus forecast. There is a report earlier on Bloomberg from UniCredit fixed income strategist, who UniCredit is estimating that is going to bring about more than 300 billion euros of total cash in the system. More flooding, if you will, of the financial system with additional 300 billion euros, and an expansion of the European Central Bank's balance sheet, which was at almost $3 trillion, more than $3 trillion in terms of US dollars, 2.8 or 2.9 trillion euros, which in terms of US dollars, based on the latest exchange rate for the euro versus dollar, is even more than $3 trillion, even more than the Federal Reserve balance sheet, which was also alarming when we discussed that a few months ago. So that, I think, the European Central Bank's LTRO second round on Wednesday could be a potential risk event for the euro. And now that we're seeing the euro actually breaking higher versus the US dollar, now will take us to the daily chart of the euro-dollar currency pair. And last week we talked about that level of resistance here at the $1.31, $1.3321, which was the level of resistance that I said the euro, if it stays below it, the euro could head lower to the bottom of that existing range. But if it were to break higher, I said don't be surprised to see the bullish for the euro scenario playing out, especially if the Eurozone economic data was on a positive side. And on Wednesday, we didn't see the Purchasing Managers Index really helping. The composite Purchasing Managers Index from the Eurozone was below 50 again, unexpectedly. So that didn't help. But on Thursday, the IFO Business Climate Index in a Eurozone, or in Germany rather, was higher than the consensus forecast and higher than the previous month, which I said that would not be surprising because the ZEW index last week was also higher. So the ZEW is sort of a leading indicator of the IFO. So it could lead to the IFO index being higher. And I said if that economic data from the Eurozone were to give the euro a bit of a boost, maybe that could be the catalyst, coupled with the optimism returning to the markets after the Greek bailout was approved, the bailout package and so forth. Those were the factors that I explained last Friday on this program that could cause the euro to go with that bullish scenario and actually break higher versus the US dollar. And then I said very quickly after that we could see the euro rallying and making a move to towards the large quarter point of the $1.35, which is an important level in my quarter steer. And I even said we might even see the euro a little bit above $1.35, considering that on December the 2nd we had a resistance established at the $1.35.48, which is roughly $1.35 and a half area. So should not be surprising if you listen to this webinar last Friday to see the euro going with that scenario, breaking above $1.33.21 decisively. That was the resistance that the euro was to target, and that opened the door as anticipated to a move towards $1.35. Now, obviously today we're seeing an intraday high at $1.34.75, which is 25 pips from the targeted large quarter point, $1.35. As I said earlier, I would not be even surprised if we get to see a little bit of a move above $1.35 to the resistance, that area of resistance here from December. But the bullish breakout on the euro-dollar pair daily chart that we were expecting has occurred. And however, as we are in the next couple of weeks starting to gauge the next move of the European Central Bank, and as we approach that second round of long-term refinancing operations by the European Central Bank on next Wednesday, that could be a risk event if due to the factors I explained earlier. And then the very next day after next Wednesday, we're also going to see the preliminary flash estimate for the Eurozone harmonized index of consumer prices, which I will talk about in a few minutes. But if the harmonized index of consumer prices, which is the main gauge of inflation in the Eurozone preferred by the European Central Bank, shows that inflation is not rising, then that could create the type of more comfortable environment, as I would like to call it, for European Central Bank policymakers to consider further accommodative monetary policy, which also could include further interest rate cuts by the European Central Bank going forward, especially if economic conditions continue to deteriorate and we continue to see the European debt crisis not completely over with. So on Wednesday, with the European Central Bank LTRO, and on Thursday with the harmonized index of consumer prices, those could be the risk events that could weigh on the euro, and the euro could encounter resistance within the $1.35 to $1.35 and a half area, and we could see a potential pullback kicking in for the euro, which, by the way, would be due, considering also the fact that the recent bullish wave here after the bullish breakout, the euro is extending its gains, but it's been rallying now for 6 trading sessions. And to my personal standards, as I also explained in my book, The Quarter Theory, the current bullish wave and a bullish move for the euro versus dollar is beginning to look extended, a bit stretched. And granted, the market could push the euro higher for another 6 or even 60 days if it likes. But we have to consider that as a potential red flag that could signal that a price correction could kick in at any time, especially when we get to these trend waves becoming extended. And considering that there may be strong resistance encountered in that area of the large quarter point at the $1.35 to $1.35 and a half area, then that could be the area that if the euro encounters that resistance next week and these economic reports weigh on the euro, we see the pullback. Where would the pullback take us to? Well, you have a lot of previous familiar support resistance levels that during such price correction for the euro could be targeted. The first one, of course, would be the $33.21 level, which was the previous resistance, which we broke in the last couple of days. And on the way down, that resistance could establish itself as a level of support. The large quarter point is right below there at the $32.50. $32.32 was another resistance level there from, what was it, January 27th. A little bit below that level, you had the support level here from November 25th at the $32.12. That's what I meant by saying that there's reliable support, previous support resistance levels that could be targeted if the euro should encounter resistance next week around $1.35, $1.35.5, and then pulls back from that area to $33.21 or the large quarter point area, $32.50, or maybe even the $32.12, which was the support from November 25th of 2011. So this is a scenario that we should be aware of as we head into next week. The sequence of important U.S. economic data is going to continue on Wednesday with the second estimate for the U.S. GDP economic growth in the fourth quarter of 2011. The previous estimate showed us the U.S. economy growing by 2.8%, and the consensus forecast is pretty much expecting no revision to that number. 2.8% is the consensus forecast for U.S. growth in a fourth quarter. Compare that with minus 0.2% in Germany this morning. And the UK GDP report, also the second estimate came up to show the UK economy contracting by 0.2%, also in fourth quarter of 2011. You get an idea as to what economic conditions were in the U.S. or in the Eurozone, in Germany, the largest economy. And the Eurozone GDP contracted as well, as expected in the fourth quarter, so that was not a surprise a few weeks ago that we discussed. So, obviously, in the fourth quarter, the U.S. economy was stronger than the U.K. or the Eurozone. And as long as that continues to be the case, of course, as long as there's no downward revision on Wednesday, that 2.8 growth revised down to 2 or, lower, then provided there's no disappointments, as I said earlier, that could continue to show strength in the U.S. economic data, which ultimately reduces the odds for more quantitative easing by the Federal Reserve. Next Thursday, we're going to pay very close attention also to a couple of important economic reports from Switzerland. Maybe not a lot of people will talk about these reports, but I think that these reports are going to be very important because many of you pay attention to the Swiss franc have probably noticed that there is a renewed strength in the Swiss franc in recent couple of months. It is pushing the US dollar lower to the 90 cents level. It is pushing the euro lower towards the floor that was established on September 6th of last year by the Swiss National Bank to curb the strength of its own currency, the Swiss franc. And as of today, it is trading, the euro Swissy is trading pretty much about 45 pips or so from the floor, above the floor. So it's very, very close. This is why next Thursday, Consumer Price Index and GDP report from Switzerland are going to be key events to watch, especially for those of you who do pay close attention to what the Swiss franc is doing and are trying to gauge the next move by the Swiss National Bank, which, in my opinion, as I have been saying for months, is not completely done as far as its efforts to curb the strength of its currency, the Swiss franc. And further deterioration in economic conditions in Switzerland and further threat of deflation could only raise the odds that the Swiss National Bank could be prompted into doing something more to weaken the Swiss franc, which is not only going to include an actual intervention, it may also, as I have been saying for months, it might also include a much bolder move than an actual intervention. Rather than just going and selling the Swiss franc and buying dollars and euros to weaken the Swiss franc, may not be enough. The Swiss National Bank may be forced into doing a more bold decision, which could include, as I have been saying for months, it could include raising the floor for the Euro-Swiss exchange rate from 1.20 to maybe even up to 1.30. In a similar move that we witnessed in September of last year. I am not excluding the possibility of that. Now, this couple of important reports from Switzerland are also going to come a couple of weeks before the Swiss National Bank's monetary policy meeting, which is due on March the 15th. And they can also help us gauge the next move of the Swiss National Bank, as I said earlier. Now, the Swiss Consumer Price Index is expected to stay below zero, which is in deflation territory, 0.7%, minus 0.7% year over year is the consensus forecast. It is also expected to drop by 0.4% month over month. So this deflation is going to continue, more than likely to be a threat in Switzerland, according to the consensus forecast. The Swiss gross domestic product report, on top of that, is expected to show the Swiss economy contracting in the fourth quarter of 2011 by 0.1%, quarter-over-quarter contraction, compared with 0.2% growth in the third quarter, quarter-over-quarter. This is going to impact the year-over-year growth in Switzerland from 1.3% year-over-year to about 1.1 or even 1% year-over-year. In other words, the GDP report could show us slower economic growth, or rather contraction on a quarterly basis, and slower year-over-year economic growth in Switzerland, mainly also due to the problems in the Eurozone, which is the largest economy, largest trading partner for the Swiss economy. Both of them very closely related, and the Swiss economy very dependent on conditions in the Eurozone. And then on top of that, the consumer price index could show us that the threat of deflation is still there, and this is why I said earlier we could see the odds increasing for the Swiss National Bank to do something which could increase the nervousness in the market ahead of the Swiss National Bank's monetary policy meeting on March the 15th. And so you should not be shocked to start seeing the Swiss franc beginning to weaken in the next couple of weeks. Moving forward, we're going to see on Thursday of next week the Eurozone harmonized index of consumer prices. Now, that's the main measure of inflation prepared by the European Central Bank. I also already mentioned earlier what the implications of that report could be, especially if the inflation gauge continues to drop in the Eurozone. Despite of the fact that we had two aggressive interest rate cuts by the new president, Mario Draghi, who undid the previous president Trichet's two interest rate hikes earlier in 2011. Despite of inflation pressures spiking to 3%, the European Central Bank cut the rates by 50 basis points, bringing them back down from 1.5% to 1%. And despite of the cut, inflation pressures in recent months in the Eurozone have begun to subside from the peak at spike to 3% in last summer to 2.7% in the last couple of months, 2.8 and then 2.7%. And now the consensus forecast for the flash estimate next Thursday is expected to show even further decline in inflation pressures to 2.6% year over year from 2.7% in the previous month. In other words, that flash estimate next Thursday of the Eurozone harmonized index of consumer prices could show us that inflationary pressures are subsiding and inflation is no longer a problem in the Eurozone. which, as I explained earlier, creates a more comfortable environment for the European Central Bank to maintain its accommodative monetary policy. And it could even make it more comfortable for policymakers to consider further rate cuts, which could weigh on the euro as the market next week gauges what's going to be the next move by the European Central Bank at their monetary policy meeting on March 8th, which is the Thursday after next Thursday. So as I explained earlier, the European Central Bank's long-term refinancing operations and the Eurozone harmonizing the consumer prices could be the two risk events that could weigh on the euro next week. And it could trigger that price correction that I was talking about earlier. Next Thursday, we're also going to continue the U.S. economic data with the personal income and outlays report, which is a measure of consumer spending, consumer income, and it also contains the so-called personal consumption and expenditures index, which is a preferred gauge of inflation by the Federal Reserve. Inflationary pressures are important to stay elevated in order for the Fed not to consider more quantitative easing, obviously. And the PCE price index, the core PCE price index, according to a consensus forecast, is expected to increase by 0.2% in month over month, which means that we could see inflationary pressures picking up a little bit. Of course, we have seen the spike in oil prices as well, which is also could cause inflationary pressures to increase. And as long as inflation pressures stay elevated, then the Fed may not be considering at that kind of environment additional quantitative easing. Personal spending is also, which is very important part of the U.S. economy and very important for U.S. economic growth, as the U.S. economy is about 2/3 consumer spending dependent. Only about 1/3 is manufacturing. All the rest is services, which, services industries are consumer spending dependent. So the consumer spending is expected to increase by 0.4%. Personal spending month over month. Consensus forecast is for an increase by 0.4%, compared with 0% increase in the previous month. That could be another positive U.S. economic report on Thursday. And following that report, we'll see the U.S. Institute for Supply Management Manufacturing, which is the leading indicator of economic conditions in our manufacturing sector in the U.S. And the report is expected to show another month of growth in the U.S. manufacturing, a reading of 54.7 from 54.1 in the previous month. Many of you know that with the Purchasing Managers Indexes, 50 is the important line to watch. It's the dividing line between economic expansion and contraction. A reading below 50 indicates contraction, a reading above 50 indicates expansion. So we could see another month of expansion from U.S. manufacturing with that report. And as I said earlier, looking at these consensus forecasts at a first glance today, it looks to me that most of the U.S. economic data will remain on the positive side, which could continue to instill some cautious optimism as far as conditions in the U.S. economy, with the exception of the durable goods orders, which could be a bit of a weak spot with the expected decline there. The rest of the economic data looks more on the positive side. Now, next Thursday, we're also going to see the testimony from Fed Chairman Bernanke at 10 a.m. Eastern Time, at the same time that the ISM Manufacturing Index is going to be released. I believe this is the testimony on a semi-annual monetary policy report before the Senate Banking Committee in Washington. And obviously, that could be important to watch as well, although we already know where Mr. Bernanke stands. If he had his way, we could see quantitative easing being deployed very, very quickly. And don't be surprised if it is, if we get to see some signs of U.S. economic conditions deteriorate. But as long as I said earlier, as long as the U.S. economic data shows resilience, we could see the odds being reduced for more quantitative easing by the Fed, which ultimately could also be a U.S. dollar positive. Many of you would probably remember the first round of quantitative easing, especially QE number 1, when it was announced. It was not pretty for the U.S. dollar at that time. And more quantitative easing could keep the rally in equities and markets going, but it will be at the expense of the U.S. dollar more than once. And I would not find more quantitative easing from the Fed to be a U.S. dollar positive underlying fundamental development. There's a question from one of our listeners. He says the liquidity released by the European Central Bank to the major banks is likely to be hoarded by the banks with indebted balance sheets, and little may be used as loans to stimulate growth. As a question, it is a great point. And in December, when the European Central Bank was doing the first round, I said that for them to anticipate that this is going to stimulate growth a whole lot would probably be a little bit too optimistic. All they had to do is take a look at what the QE number 1 and QE number 2 did here in the U.S. and the Fed's lending as well, that did in the U.S. The banks hoarded the cash. Instead of lending it to consumers or small businesses to stimulate economic growth and consumer spending and business, they hoarded it and they invested it in U.S. Treasuries. They got the record low loans from the Fed and then reinvested into U.S. Treasuries, and there was very little that went into the actual economy, so to say. And so it was pretty much the same thing in the Eurozone, but on the other hand, it did help the debt crisis there, because a lot of these banks who borrowed the money from the European Central Bank, turns out they bought a lot of bonds from Italy and Spain. Now, it is questionable whether they will have the same type of appetite going forward. And that could be one of the risk events as well. But I agree. I don't think that there's going to be a whole lot of stimulation of economic growth, especially if they're hoarding the money and are not lending it to businesses and individuals, but rather investing it into government bonds. You see, this is a very smooth type of a scheme, because the European Central Bank, by law, is not allowed to lend directly to governments. It cannot write a check to a government. And so by lending it to the banks, which in turn turn around and buy government debt of their own countries, it's an indirect way for the European Central Bank to help the governments of the Eurozone. So without a doubt, it's a very, very important event that should be on your watch list for next Wednesday, what comes out of this long-term refinancing operation, second round by the European Central Bank. And in the final of the top 10 spotlight events next week, I have chosen to come from Japan next Thursday night at 6:30 p.m. Eastern Time with the Consumer Price Index. Just as the Swiss Consumer Price Index, the Japanese Consumer Price Index has been heading recently below 0% in deflation territory. And the National Core Consumer Price Index is expected to show another month below zero, a reading of minus 0.1% year over year is the consensus forecast for the National Core Consumer Price Index in Japan. Now, many of you have seen the recent rally of the US dollar and other currencies versus the Japanese yen. And the fact that deflation is once again becoming a threat in Japan, I've explained months ago that it increases the odds for the Bank of Japan to continue to be accommodated with their monetary policy. And it wasn't that shocking at the latest Bank of Japan interest rate announcement to see an expansion of their asset purchase program, or the quantitative easing program, to 30 trillion yen from the 20 trillion yen level, which, according to some pundits, was one of the beneficial developments there that helped the US dollar and other currencies to produce that strong rally versus the Japanese yen and the blow right past the top of this range, which I said I wouldn't be surprised to see it break this time around. There's already been the top of that range, you would recall, was 78.27 yen. That level was established as a resistance level in December or November rather of last year. It has been tested multiple times, 3 or 4 times at least, in the months that it served as a major level of resistance. And then finally, last week, we saw that level being broken above decisively, which I said what the implications of that would be as well. A break above 78.27 yen, I said weeks ago, that would open the door to challenge the 2 post-intervention highs from October and August of last year. Those numbers were 79.52 and 80.23 yen. Both of these levels were targeted and broken above, and we have seen the dollar-yen pair reaching as high as 80.77 in a trading session today. So the party continues. However, I think that it continues also, in my opinion, with the help of the Bank of Japan and the Ministry of Finance. I would not be surprised if in a couple of months from now, we get to see the Bank of Japan announcing that there were indeed some so-called stealth interventions that have been done in recent weeks to help this US dollar rally versus the Japanese yen. Especially, I said I didn't feel that there's going to be enough strength from the dollar to break much more decisively above the 80.23 level unless there is additional help by the Bank of Japan, which could act with more interventions on behalf of the Japanese Ministry of Finance. And therefore, with that move, that is now lasting for 3 consecutive weeks without any significant price correction and a pullback for the dollar versus the yen, I think, and I'm suspecting, that there is something behind it in a way of potential stealth, unannounced interventions by the Bank of Japan. The recent news of the stealth interventions in November is what I'm referring to, which the Bank of Japan said earlier this month, that in November of last year, they did some unannounced so-called stealth intervention. And I would not be surprised if they announced that they did some in the recent several weeks to keep this party going. However, although the dollar is breaking higher, and that's a technically bullish development, there are some red flags. And those red flags are the fact that this is a very strong rally, but is becoming at this point too stretched for my personal taste. And so I would think that there is going to be a pullback, a more significant price correction that the dollar-yen pair is long overdue. The rally is stretching there for the euro against the Japanese yen. I'm not sure if you pay attention to that currency pair, but if you take a look at it, there's already more than 1,000 pips that the euro has managed to rally from its recent 12-year lows versus the yen. And so that one's becoming a bit too stretched as well. So be cautious when it comes to the rally there for the dollar and the euro against the Japanese yen. But the Japanese Consumer Price Index report next Thursday will more than likely be in line with market expectations that there may be further continuation of the accommodative monetary policies by the Bank of Japan, considering that the deflation is once again a problem in Japan, according to a consumer price index falling below 0%. Well, that's about all. And of course, if there is a further continuation of this rally, we do have a lot of important previous resistance levels that are around 81.5 area. And if that area is broken above, we may even see the dollar completing the first quarter of the new 1,000 pip range, the 80, between 80 and 82.50. And there was some previous resistance around the 82.50 area as well from last year. But be cautious when it comes to this. I think it's a bit stretched. I think that a healthy price correction and a pullback would be a welcome development we'll see some consolidation, and then if there's further strength in the dollar or the euro, we could see another leg higher after the correction is over with. But a long due price correction, I think, is due here for this currency pair and for the euro against the yen as well. Well, that's about all the time we have for today's program. Let's see here. Someone is sending a question on the yen. This weakening of the Japanese yen will help Japan service its debt and increase exports. Yes, it's a very welcome development by Japanese authorities, without a doubt. They are cheering these developments, but I suspect that they are behind, at least partially behind, what's happening now, which is a good thing. If for a long time they've been trying to weaken the Japanese yen, and it's not been that effective, and finally now we're seeing some success in that. And months ago, in the fourth quarter of 2011, on my program, the All Things Forex broadcast, I devoted an entire program on making the case as to why I'm starting to see some alarming trends emerging in Japan, and that could threaten the safe haven status, if you will, of the Japanese yen going forward. And I even went as far as calling Japan a ticking time bomb. And you can go back and listen to some archives if you can dig it out. And all the archives are, by the way, available on allthingsforex.com of the All Things Forex broadcast. Speaking about the All Things Forex broadcast, I would like to invite you to listen on a daily basis, 1 hour program, Monday through Friday on allthingsforex.com. You can also follow me on Twitter at allthingsforex is the Twitter account, at allthingsforex. Thank you very much to our friends at FX Street for putting together these series of webinars. And thank you all very much for attending the webinar today. Have a great day and a great weekend, and I look forward to seeing you again next Friday at 10 a.m. Eastern Time.